This problem states that Palmer Cook Music Productions manages and operates two bands. The company entered into the following transactions during a recent year. And instead of reading each one of the transactions up front, I'm instead going to read them as we go along through them, because the first requirement asks us to prepare the journal entries associated with each one of the transactions. So let's take the first one on 1-2. It tells us that the company purchased a tour bus for $104,000 by paying $38,000 in cash and signing $66,000 note due in 2 years. The accounting system, the company records a vehicle distinct from other types of equipment, so it's indicating for us that it wants us to use a vehicle account. So our journal entry is going to be debit the vehicle. It's considered distinct from other equipment, so we're not going to lump it with equipment. Credit cash, and then credit note payable. And this is going to be a long-term note payable because it's due in 2 years. So the amounts that they give us, the total is $104,000. They tell us the cash that they pay is $38,000, and the difference to the note is $66,000. All right, let's go on to number 2. On January 8th, they tell us that after the bus was used for nearly 1 week, so this is after we've already got it ready for its intended use, it was painted with logos of the two bands at a cost of $550, and this was done on account. The logos did not increase the lifespan or the operating capacity or the operating efficiency of the bus, but they were thought to be useful in promoting the bands. So since this was done after the intended use was already put into effect, so the asset was operating as intended, we're going to consider this repair maintenance. Notice it's not going to be an extraordinary repair maintenance because it indicates it did not extend the usefulness of the asset in terms of operating capacity, lifespan, or operating efficiency. So we'll debit repair and maintenance expense, which is an expense account, and then we'll credit accounts payable because it said it was on account. That amount is $550. Okay, the next one on January 30th, they tell us that the company wrote a check for the amount owed on account for the work completed on January 8th. So essentially, we're just settling our accounts payable. We'll debit accounts payable and credit cash for the check that was written, the amount of $550. Okay, the next item happens on February 1st. It says, we purchased new speakers and amplifiers and wrote a check for the full amount of $39,000. We can consider this equipment unless they had a separate account for it. But we'll call this equipment. And we'll credit cash because they said they wrote a check and paid cash for it, in the amount of $39,000. All right, next item that happens is on February 8th. They say February 8th, they paid $450 in cash for minor repairs to the tour bus. Again, this is after the asset's already been put into use. And since it was minor, we can assume that it did not extend the efficiency or the capacity or the lifespan of the asset. So we'll debit repair maintenance expense again. And we will credit cash. The amount that they paid was $450. Okay, on March 1st, go ahead and move over to the side here. On March 1st, they tell us that they paid $38,000 cash and signed a $280,000 5-year note to purchase a small office building. An appraisal indicated the building and land contributed equally to the total price. So here we need to split the entire cost equally across the land and building. To do this, we'll go ahead and sum up the total amount paid on the March 1st transaction. We've got $38,000. And again, I'm just pulling that information from right here. We've got $38,000 in cash and then a 5-year note for $280,000. We'll add these up. Provides for us a total of $318,000. They said this was going to be split equally, so the proportion is 50-50 for the land and building. So we'll have $159,000 dedicated towards land and $159,000 dedicated towards the building. So we'll go on to make our journal entry. Our journal entry, which happens on March 1st, is going to be debit land, debit our building, The amounts are $159,000, $159,000. We're going to credit cash. The amount of cash that we're paying is $38,000. And again, I'm just taking that from the information in the line provided on March 1st. And then we'll credit the note payable. This is again going to be a long-term note payable because it's longer than a year. And the amount of $280,000. All right, the final journal entry on March 31st, it says they paid $97,000 cash to acquire goodwill and certain tangible assets. The fair value of the tangible assets acquired were $23,000 for the band equipment and $61,000 for recording equipment. So to journalize this, we're going to credit cash for the full amount of $97,000. If we sum up the amount of equipment that we have, we have $61,000 for the recording equipment and $23,000 for the band equipment. That's a total of $84,000. So the amount of equipment that we're recording is $84,000. And then our difference will be goodwill. So this is the plug figure for the excess that we've paid over what the fair value of the tangible assets are. And this gives us a total of $13,000. So that they both then balance to $97,000. Goodwill is that intangible asset for items that can't be valued until someone's actually ready to purchase them. Someone actually gives up cash for them. So this takes care of requirement 1, which is all the journal entries. Requirement 2 wants us to calculate a depreciation amount for each one of the assets that were purchased. It says for tangible and intangible assets acquired in the preceding transaction, determine the amount of depreciation and amortization that Palmer Cook Music Productions should report for the quarter ended March 30th. So notice that we're only doing 3 months of depreciation. It says for convenience, the equipment and vehicle are depreciated the same way using straight line. So we have equipment and vehicle, use straight line method. It tells us they have a useful life of 5 years and no residual value. It also tells us that the building is depreciated using the double declining balance method. It indicates it has a 10-year useful life. And it indicates that the residual value is $38,000. Now, this information was given to me in my problem, so yours might be a little bit different. Just look at the requirements for requirement number 2. That's where this specific information is pulled from. I've written it out here so that we can just utilize it to calculate this example here. Okay, first thing we're going to do is calculate the vehicle. So with the vehicle we purchased right up here, the capitalization price was $104,000. So we're going to take $104,000. We'll subtract out residual value, which is 0. In this example, and then we're going to divide by the useful life. They tell us that the useful life right over here is 5 years. This gives us a total amount of $20,800. But remember, this is a full year amount, so we have to take into consideration how much are we actually depreciating. They tell us that they only want us to depreciate for the first quarter. So we're going to multiply this by 3/12 because we're only depreciating up to March 31st. This then provides this amount of $5,200. So this is our amount for the vehicle. We're now going to go on and calculate the next item, which is going to be the equipment. That had a cost of $39,000. So we'll take $39,000, subtract out the residual value again. Residual value is 0. We'll divide by the useful life. They tell us again the useful life here is 5 years for the equipment as well. So we'll take 5. And then this gives us a total amount of $7,800. Now we're going to multiply this by the fraction of the year it was used for. Notice that this happens, the equipment purchase happens on February 1st. right here. We can see that here as well. It's a little bit small. If we want to make it bigger, it happens on February 1st. We buy the new speakers and amplifiers. So we are only multiplying this by 2 over 12 because we weren't outstanding for the full 3 months. Remember, we're only doing the 3 months to begin with, the first quarter. But we are only outstanding or using this asset for 2 out of those 3 months. So multiply by 2 over 12. And the reason why it's over 12 and not over 3 is because the 7,800 right here is calculated based upon years, 5 years, not months. Okay, so multiply that out, and that gives us a total of 1,300. That is the amount that we will have for the equipment. The next item that we'll calculate is going to be the building. Remember, we don't depreciate land, so we're instead doing the building. So for the building, our cost that we have for the building is going to be $159,000. Now we subtract out accumulated depreciation. Remember, not residual value, but accumulated depreciation. And accumulated depreciation is 0 for that first year, so we're also subtracting out 0 here. We're going to multiply this by 2 over the useful life. The useful life for the building is 10 years, so we'll multiply it by 2 over 10. This produces for us $31,800. Now we're going to multiply this for how long it was in use. The building was purchased on 3/1, so we're going to multiply this by 1 over 12 because it was only 1 month of the quarter that it was utilized, and it's over 12 because our useful life right here is in years. And so this gives us a total amount of $2,650. And this is our amount that we would have for the building. The final requirement says prepare the journal entry to record the depreciation calculated in requirement 2. So what do we do with all of this depreciation calculation? Well, our journal entry is going to be to debit depreciation expense. Notice that we have a different type of non-current or fixed asset that we're calculating depreciation on. So we'll probably have a different accumulated depreciation for each one because the accumulated depreciation offsets a specific account. Most of the time that these are grouped when we actually do the financial statements, but internally we often keep them separate to track the remaining costs that's available for use. So we have 3 different accumulated depreciation accounts, 1 depreciation expense. The amount that we're going to record for our vehicle is $5,200. We've already calculated it right here. Same here, same here. So $5,200, $1,300 for the equipment, and $2,650 for the building. We'll sum all those together. We get $9,150 for depreciation expense.